So the market is about to crash, and if you are a day trader, an options trader, anything, this is a very big time for you because you can make a lot of money. This is just my opinion. The market is about to go to recession. I'm Brian Mitchell, and let's bring all the evidence as to why this is actually about to happen. During the during three of these times, okay, there was a significant underlying problem in the economy, and because there was an underlying problem, they lowered the interest rates during those times. Okay, so I'm going to pull up the interest rate graphs, all three of them from those times, and let's look at 2000, right? I want you to pay attention. This is the federal funds effective rate, and shaded areas indicate U.S. recessions. The dot-com bubble happened. Gray areas of U.S. recession, they lowered rates significantly. Okay, here's the next time. This was in 2020, but we see they lowered rates significantly before they even locked everything down. They knew this was coming. Gray area represents recession. They lowered rates significantly. Let's look at the 2008 one. All right. They lowered rates significantly. We were in a global financial crisis. We were in a U.S. recession. There's an underlying problem. There is an underlying problem in our economy right now. Okay. And I want you to look at all of this evidence. The U.S. Federal Reserve market is expected to cut interest rates at least once during its four remaining meetings. Why would they be wanting to cut interest rates during these last four meetings? They're going to cut rates in September, but why? Okay. I want you to think about that. Let's look at our next piece of evidence. The job reports fell way short of expectations. Okay. They added less jobs than predicted. What does this mean? Companies are not interested in hiring people because they either don't have the money or they're trying to save the money. Lowering interest rates makes it cheaper to borrow money. So if it's cheaper to borrow money, they're going to borrow more money. That way they can allocate more money to hiring people, therefore increasing jobs, right? That's what should happen in a good economy. But if they're adding less jobs, that's a sign that the economy is shrinking. Now let's talk about the Japanese crash, okay? And this will be very significant. But first, you need to understand what a carry trade is. A carry trade is a trading strategy that involves borrowing at a low interest rate and investing in an asset that provides a higher rate of return. The Japanese stock market crashed significantly. You can go do research on this. It wasn't just a small pullback, it crashed. Like their market was wiped out, all of the gains from this year 30%, right? They were borrowing money at a low interest rate and investing in other things that they thought would make them more money. Now that their stock market has crashed, think about the fact that they need money now. Okay. And now let's think about the fact that Japan has been a significant foreign investor in the last recent years. They've been the top investing country in the United States. So what were they doing? They were taking that money that they borrowed at a low interest rate, putting it other places such as our market, right? Well, they're gonna have to pull that money out to fulfill their needs because they don't have money right now. So look at the U.S. stock market. Let's look what happened in the first week of of August during that news. The U.S. stock market falls 8% in 4 days. It's not a coincidence. It's not a coincidence. And JP Morgan says the carry trade unraveling is only half complete. Why would JP Morgan, the biggest bank, one of the biggest banks in the United States, say that this is not over yet? Because they understand that the Japanese markets are crashed, they're cooked, and they're going to need to pull money from the market. Okay, the Taiwanese market also crashed because of this. Why? By fear of a deeper U.S. economic slowdown. There's an underlying problem in our economy, but they want you to think that everything's fine. And so I'm not here to scare you about the fact that the market's going to crash. If you're a long-term investor, by all means, hold for the next 40 years because it'll go back up. But for short-term traders like me and you, for options traders, buy puts. This is not financial advice. This is what I'm doing, but buy puts, essentially. Okay. We see in the stock market volume right here because everybody's buying the dip, but they're not looking at these underlying problems. So when the Fed cuts rates in September, they're cooked. Okay. I want you to look at where all the volume was. Look at all the volume was at sell off, right? Okay. So if price comes up here, all the way up here, and it can't break past all of this volume, all the sell side volume, the market is going to come down. And guys, as the market comes down, the banks trade with computers. So these computers are automatically going to start fulfilling orders, right? If the market starts crashing and crashing and crashing. The Japanese investors need to get out. Our US banks need to get out because things are about to slow down. The US market is about to crash. And so I'm buying puts. I don't know about you guys, but here's the evidence. Comment what you think below, and peace.